So this is to explain why I say that the regulation of the over-the-counter derivatives market is key to the larger issue of regulating the shadow banking system. I'm showing on the right-hand side here an old line, so-called old line asset manager, which is taking some client capital and investing it in risky bonds. Now, one of the consequences of the revolution in modern finance is that this same risk exposure for these clients can be achieved without holding any risky bonds at all. Instead, a portfolio of credit default swap derivatives and a portfolio of interest rate swaps to move from long-term interest rates to short-term interest rates, and you could invest all of the client capital actually in the money market. And this would give you the exact same risk exposure as risky bonds if you choose it right. Now the point is that the shadow banking system to some extent can be understood as the mirror image of that, because the shadow banking system is in fact investing in risky bonds here, okay, but buying insurance and then funding itself in the money market. Okay, so one way to look at this, what you see in the economy as a whole, is that there is a large growth in money supply, money demand, financing the expansion of credit. Okay, that's what the asset bubble was about. But there's another way of seeing what's going on here. Is it's about risk intermediation, and there are dealers here who are taking the opposite side of these exposures here. It is these dealers then, regulation of these dealers, backstop of these dealers, which is going to be key to understanding how we're going to regulate the shadow banking system.